Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Now, if we kind of break down, just to make a couple of observations here, in the event that the YUK stays the same, the in-the-money option holder is only risking the $1.70 in time premium and has a lower break-even point, which means that as long as the underlying pair value is trading $1.70 or 1.70 or 1.70 units above the break-even point, above the strike price, then we have a break-even trade. However, the at-the-money option holder risks the entire premium of $4.15 and has a break-even point of 88.15 instead of 85.70. So the underlying pair has to move that much further in order for the at-the-money option contract holder to benefit. So again, the idea is that if you're somebody whose objective is to just take advantage of a bigger picture trend where you feel over the next couple of months that the pair is going to trade up and around, let's say, that $88 mark, rather than choosing an option contract that is going to be just breaking even up there, choose an option contract that is in the money that will be profiting as the underlying pair value trends in that direction, offsetting the risk in time and capitalizing much more greatly on that on the increased option delta. Okay. Now, here's what becomes a very interesting observation here. With only a 5-point increase in that underlying pair value in the YUK, the in-the-money option holder is actually going to benefit much more, because the more that option contract moves deeper in the money, the higher the delta and the more influenced dollar for dollar that the move in the pair value is going to have. So in fact, with the option contract, let's say with the YUK increasing $5 5 points, and actually considering the fact that our $10 just over 10-point investment is now worth 14, we actually profit 31%. Now, Jennifer has a great question. Perfect. What if you get assigned early? Guess what? These are European-style options. There's no risk of assignment. You're not an option writer, number one. You're an option buyer, so you don't have to worry about being about exercise and an assignment, simply because you have you have a right and not an obligation. So you don't have to worry about that. You can actually lock in your profits at any time as the option buyer between now and that third Friday of the expiration cycle. But understand that because these are European-style exercise, there's no risk of assignment. You don't have to worry about if let's say, for example, you were utilizing a different strategy and you were writing option contracts. There's no risk of assignment. And along those lines, and just to reinforce, at any point, let's say in the next 2 months, I was profiting on that deep in the money option contract. Hey, you know what? I can go in and I could sell that option contract at any time, and I can ultimately recognize my return on investment much earlier. But understand that if I choose to hold my position, and this is the benefit of utilizing that deep in the money option contract, I'm not being burdened by that rate of time depreciation that the out of the money option contract would be utilizing. And just another observation here is that you are and a great observation with respect to the risk of the in-the-money option contract is you do risk the entire premium if you get a significant drop in the pair value. So in other words, and I'm going to reference that in a couple of minutes when we talk about the pair value decreasing. But we do have to understand that we do risk the entire premium of the in-the-money option contract if it does go against us. Okay, so that's where a proper risk management strategy has to come into play. And so the idea is that, let's say, for example, again, I'm just going to use the at-the-money option contract. Remember that the at-the-money option contract has to compensate for the time value. And so the idea is that we can look at that at-the-money option contract, and we can say that, okay, I'm going to risk $4.15 on my at-the-money option contract versus that $10 that I'm paying for the in-the-money. But I can choose to risk the same amount on my in-the-money option contract. In other words, my rule could be that I'm not going to lose any more than $4 per contract or 4 points per contract on this in-the-money option. So I don't have to risk the entire premium if I don't want to. I can choose to offset that position at any time if it goes against me. But one thing that I just want to reiterate here, guys, is that the at-the-money option contract, based on that same move, has to compensate for the time value component. So when we consider that, let's say the YUK increases up to 89. Well, if we take the 89 YUK settlement minus the 84 strike, we really only have an intrinsic value of 5 points. We take the 5 points, we subtract the 4.15 premium that we paid, and we actually only have a profit of 85 cents, which is a return on investment of about 20%. So it's not a bad rate of return, but recognize that that rate of return is actually less because of the fact that the pair value had to compensate for that for the time value component. And again, what the pair loses in time, it has to gain back in intrinsic as we move towards the expiration date. Now, just a quick question being tabled here online: is there an option to adjust if the trade is going against you? Absolutely, you can adjust your option contracts. There's many different ways that you can still stay with a position and make adjustments. So in other words, our at-the-money option contract, let's say we're losing money on that, we could simply create a spread out of that. So we sell two of the option contracts that we bought. We take the premium that we've generated, and then we go in and we roll down to a lower strike, and we create a spread. Obviously you need to do the math to make sure that the profit between the spread that you've created is going to be sufficient to make it worthwhile. But we can adjust these positions at any time before expiration. Remember that even though they're European-style exercise, guys, the fact is we as the option holder can do what we want with it. So we can adjust our positions. We can sell our positions for profit. We can lock in profits by selling, a portion of our positions at any time before that expiration date. Now, again, if the YUK decreases the 5 points, well, the in-the-money option contract holder is going to lose almost dollar for dollar. And so that is an important consideration, guys, because the fact is, if the option contract or if the underlying is trading below the strike price of the in-the-money option, well, ultimately, you know that you run the risk of losing the entire premium. And this is why I say that you always have to make sure that you are implementing some sort of a risk management strategy. And so bottom line is, let's say, for example, I'm using my price charts. Well, if I got into that trade because the YUK was trending to the upside based on my moving averages, well, if I see those moving averages rolling over, I'm not going to stick around and let my entire option contract go to waste. As soon as it starts to move against me, I'm going to offset my position, cut my losses, and move on to a new opportunity. So the onus is on you to manage for your risk, but recognize that if the YUK drops, let's say, the same amount by $5, well, we're going to risk that much in intrinsic value, which means that if the YUK settles at 79 and we own that 79 strike, actually, John just made a good point. The difference is actually going to be 670 here, not 570. But the idea is we're going to lose that amount of intrinsic value plus the time value component. So the idea is that we're going to have a $4 intrinsic value. When we subtract the $10.70 premium, we're actually going to come up with a loss of $6.70. So our loss on that our maximum loss on that 5-point drop is actually going to be greater than the $4.15 loss that we're going to incur if we just simply let that at-the-money option contract expire worthless. And so these are the considerations that we have to make. And one thing that you're always going to see in the options world is that there's always going to be a trade-off when it comes to what option contracts you select. But what I say is that we have a choice as to how much we're prepared to risk. So if I see that the YUK is not trending in my favor, if I'm using a deep-in-the-money option contract, I'm not going to sit back and just let it go against me and right until the expiration date. I have the right to cut my losses at any time, so I'm going to mitigate my loss on that particular position long before I ever get to that greater than 50% loss on that position. I'm going to actually not risk any more than what I would risk on my at-the-money option contract, or in fact, I'm going to have it significantly less, depending on what my outlook is on the price charts. I'm going to have my escape strategy, if you will, already put in place, so that I'm not risking. I'm not going to stay with that trade all the way till expiration, unless it's moving in my favor. So again, if the YUK drops that 5 points, we risk more on the in-the-money option contract than we do on the at-the-money. So just one last example here very quickly before we wrap things up this afternoon. I'm just going to take just illustrate the a bearish outlook, let's say, on the EUI, the U.S. versus the Euro. And here's a price chart that I snapped this afternoon. And the idea is that we know that the U.S. dollar has been trending to the downside against the euro for quite some time here, and my observation was that there was a support level here on this particular pair. Now, here's the thing: it could work the other way around too. We might see a break above 71, and we might want to buy some call options. But on the other side of it, if we see a break below 70, we might ultimately be looking for a continuation to the downside on the euro. We want to capitalize on that move as effectively as possible. So the idea with that break below 70, we're going to go to the options market. We're going to look at the EUI options, which are reflecting the U.S. dollar versus the euro, and they're trading at the particular pair value was at 70.30. We're looking at December options expiring. Now the comparison here is that an in-the-money 80-strike put is asking 10.40, but the intrinsic is sitting at around 970. The time is sitting around 70 cents. There's a delta of 0.93. Now remember, all put contracts are listed with a negative delta, so the delta here is negative 0.93. And the break even here on expiration is in fact 69.60. The other alternative is that we could use just a slightly out to at-the-money option contract, and it's listed at 2.11 with zero intrinsic value and $2.11 of all time. So you can see the difference in the time component. And the idea is that if we're looking to capitalize on a dollar-for-dollar move much more effectively, we're going to put up more capital, but the delta for that in-the-money option contract is sitting at negative 0.93. So for every 1 point that the EUI drops in our favor, we're going to generate 0.93 cents on that option contract, and our break-even point is significantly less than what it would be if we use that 70 strike put option contract. So in other words, we can hold that option, the 80 strike option contract as long as we want, as long as it's trending in our favor, as long as it's actually trending below that 69.60 level, because we know we're going to profit anywhere below that. Whereas we need to overcome that 67.89 break-even point that comes along with paying $2.11 for the 70 strike put. So when we put that up on a chart, as I often like to do, we can see that once again, we're consolidating along this particular level here, and the idea is that with that deep in the money option contract, our break-even point is recognized much sooner than it would be if we use that out of the money option contract, which means that we can in fact choose to stay with that trade as long as we want, or much longer than we want, and hold it for as long as we want, recognizing that we are going to profit and continue to profit anywhere below this point here versus having to wait for this break-even point here. So the idea, guys, is that we always have to consider our pros and our cons. The advantage of an in-the-money option contract is that we have a large intrinsic value in the option contract, which actually mitigates the time component that we have to deal with. That high delta means that we're generating a rate of return greater on a dollar for dollar or a 1 for 1, 1 point for 1 point basis. So it's reflecting a move in that underlying much more effectively, being less subjected to that rate of time depreciation, and that the other side of it is that expansion and contraction of volatility, which I didn't even get into. So the higher the deeper in the money the option contract, the smaller the time value, the higher the delta, the more that position is going to reflect that of a move in the underlying pair value. The disadvantage, of course, guys, is that we're going to have to put up more of an upfront investment, so we're going to have to dig a little deeper into our pockets. And again, just as we illustrated earlier on, a wrong move in the pair value can see that intrinsic value disappear. If we lose all of our intrinsic value, well, ultimately we're going to see that option contract expire worthless. So we have a greater risk of that option expiring if we do not take action. But again, what I need to reinforce is that you can cut your losses at any time before expiration, which ultimately means that you don't have to risk that entire premium. So hopefully that gives you guys a little bit of an insight into why you would choose a deep in the money option contract over an at the money or out of the money option contract. And just as a quick reminder before I pass it over to Katrina here, is recognize that there are a number of fantastic webinars available throughout the month at fxoptions.com, and you can visit that particular site. It's an amazing site. Guys, I can't tell you enough how amazing that site is. You guys hear me rave about it all the time, but you can visit the site to see more information on the various speakers that they have coming up over the next month, and recognize that the ISC strives very, very hard to bring you different topics and different speakers to create a diverse approach to trading these the different pair values available. So with that in mind, I'm just going to pass the mic, if you will, back to Katrina, and she can give you a little bit more insight into what's available at the fxoptions.com site. But guys, really want to thank you so much for joining us here this afternoon. And just a quick shameless plug, guys, before we go back. We run weekly workshops online. If you want to learn more, just visit us at optionsource.net, and you can learn more about that. So on that note, Katrina, I don't know why I'm having trouble. I've got another webinar to do.
That's all right. I do that half the time anyway.
So I'm a little tongue-tied, so I apologize. It's easier to say Steve.
You know what? You can call me Steve. I think everyone will feel a little bit more comfortable with that too.
No, listen, you've done a fantastic job, and I really do appreciate the opportunity to work with you guys here. And so I'm going to give you an opportunity to obviously go through the site. But again, guys, I can't tell you guys enough how what a great job the ISE has done at putting this FX options site together. So I'm going to leave it up to you to kind of go through the rest. And thank you so much for the opportunity. I'm going to sign off so I can prepare for my next webinar. So thanks again, and everybody enjoy your evening. Bye for now.
All right. Well, thanks again to Jason for his insights today. Thanks to all of you for joining us. As Jason mentioned, fxoptions.com is a great resource if you're sort of new to the product. So if you'd like to learn more about the FX options we've discussed today, please make sure to visit. It's www.fxoptions.com. So you'll be able to see a full list of all the available currency pairs, plus a whole bunch of other educational resources. You can check out and sign up for the free trade alerts, which are timely recommendations based on what's going on the FX market right now. So we hope to see you at the upcoming webinars. We're going to have another one on FX again next week. To sign up, make sure to visit ise.com/webinars. You'll be able to check out the latest schedule there. So thanks again to everyone, and we will see you again next week.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.